Hello and welcome everyone to my channel, The Quality Investor. With earnings season in full swing, I've been providing commentary on various businesses and their results. This is a way for me to assess if my investment thesis remains intact, if it is a stock that I hold. This morning, Lowe's, ticker LOW, released their earnings. Lowe's is the second largest retailer for home improvement supplies in the United States behind Home Depot. And this morning's earnings release was a bit of a disappointment. They contracted across their entire business. Sales is down. Same store sales is down. Earnings per share, after adjusting for a one-time charge from last year, is down. And most disconcerting, free cash flow is down. When I first looked at the earnings, I was a little bit concerned for my investment thesis. However, my investment thesis is simple. Point one, the CEO, Marvin Ellison, has extensive retail experience and is a veteran of Home Depot, transforming Lowe's into a more efficient operator on par with Home Depot. Point two, they reward shareholders with an incredible share buyback program, reducing shares outstanding by 5.84% annually over the last 10 years, as well as paying one of the best dividends of any stock, growing it at over 20% annually the past 10 years. And my final point, they have been investing heavily to modernize their technology, to streamline operations, drive sales, and continue to expand their margins, targeting 14.5% to 15% operating margin by 2027. All right, let's get into the earnings. But first, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, hit that notification bell so you can know right away when I post more stock analysis content. We're here on their consolidated statement of income, and at first glance, nothing about this looks very impressive at all. You can see that 3 months ended for this latest quarter, they had $20.47 billion in revenue. Year over year, that is down quite a bit from the 23.4 from last year. And year over year on a 9 months ended basis, 67.7 billion versus 74.6 billion from the prior year. Not good at all. We also see here their diluted earnings per share, $3.06 versus last year's EPS of 25 cents a share. At first glance, that looks pretty good. However, once you back out the sale of their Canadian retail business from last year, that earnings per share last year turns into $3.27. So $3.06 this year is actually a pretty significant drop from last year. But there are a couple silver linings here. The first one I want to point out is gross margin. So we see here gross margin in this 3 months ended period is 33.66% versus last year at 33.30%. So a decent 36 basis point increase in the prior year quarter. And then on a year-to-date basis, it is another increase, 33.67% versus 33.51%. Also, the operating income, at least in a year-to-date, we're not going to look at last year's quarter just due to that whole Canadian sale transaction. However, on a year-to-date basis, it does look a lot better. So they've expanded that margin up to about 14.5% versus last year-to-date at 11.33% operating margin. So certainly not a great quarter for Lowe's and not even an average quarter for Lowe's. This is something I definitely want to see them improve on going into 2024. I do think a lot of the reason for this year's downturn is the general weakness in the economy. However, I want to see some real growth in the next couple quarters out of Lowe's to feel confident in my investment going forward. Looking at their cash flow statement as well, a bit disconcerting. Like I mentioned at the outset, we have higher net earnings versus the 9 months ended last year, yet we have lower operating cash flows, 7 billion versus 8.1 billion last year. The big reason there, of course, is that asset impairment charge they did not get to add back this year from that Canadian business sale, as well as looking like they're paying off some operating liabilities here. And then also capital expenditure, 1.3 billion so far this year, a little bit higher than last year at 1 billion. So that's just going to lower our free cash flow. And that's something the company did say that they're going to be investing more in CapEx. So hopefully next year we can get that CapEx a bit down and the operating cash a bit up. Another aspect of Lowe's earnings release this morning was that they lowered their guidance for revenue from 87 to 89 billion for 2023 down to 86 billion on the year. And we can see this 2023 scenario planning side from the CFO. This was released towards the end of fiscal year 2022. And in that, they were forecasting a weak market of 87 billion in revenue. So they're even below what their weak market forecast was heading in to the 2023. So one of my investment points was that they're heavily investing to modernize their technology that they're using. So we can see here on this slide, modernizing enterprise technology. And by the end of 2023, they're going to have sunsetted approximately 90% of their legacy systems. And by the end of 2024, they'll be fully on modern technology systems. Of course, that's going to drive their sales, expand their inventory visibility, and so on. And so what I was saying earlier, I want to see them start to lower that CapEx number heading into 2024, and we should start to see some of these investments paying off next year. And that's what I'm going to be looking for going forward the next couple quarters with Lowe's. However, one thing that attracted me to Lowe's in the first place was their stellar return on invested capital. We can see here that they're doing about 32% capital ROIC now, and they project that by the end of 2027 to be at 45%, which would be a staggering increase, a very impressive increase as well. And that attests to the CEO's commitment to improving operational efficiency at Lowe's. And then also the adjusted operating margin, there again is that target of 14.5% by the end of 2027. If they hit those numbers, we should see some pretty nice share appreciation for Lowe's over the next decade. So I updated my investment valuation with Lowe's new numbers from the latest quarter. This is the most up-to-date numbers for October 23 quarter. Just the system I'm using hasn't updated their data yet. However, I'm projecting now to that 86 billion that the company guided towards in their latest earnings release. I left my growth rates in years 2 through 6 for revenue. I left them unchanged. That gives us a compound annual growth rate for the next 10 years of revenue at 2%. And in order to be conservative, I'm assuming the operating margin is actually going to grow to about 13.5% by year 10, which would give us an operating income growth of 4.63% over the next 10 years. And finally, free cash flow. So I have a free cash flow conversion rate here of $1.18, meaning they're going to convert $1.18 out of every dollar of net income into free cash flow, which is a little on the lower end of their average in the last 10 years or so. So that will give us a free cash flow growth rate, when you combine all that together, of about 5.8% over the next 10 years, and a free cash flow margin expansion of about 3% per annum growth rate here. So comparing that with historical averages, we can see that the free cash flow margin growth rate is about in line with their 10-year, and I'm far under projecting what they did historically for free cash flow growth, as well as revenue growth and operating income growth. So here on my investment summary page, using an 8% discount rate for all that, I'm getting a discounted cash flow price here of $234.76. And the one bright spot with Lowe's, like I mentioned earlier, is they pay an incredible dividend. And their dividend has grown at a 20% per year over the last 10 years. And I'm factoring in about half that, even less than half that, about 8% growth for their dividend. And even at that, I get a dividend valuation model of $327.94. And once comparing with their peers, the exit multiple valuation of $243.59. That gives us a valuation average of $260.26. And once I factor in my margin of safety at 20%, that gives me an acceptable buy price of $208.21. For context, prior to updating these numbers, I actually had an acceptable buy price of about $215. So while this quarter was certainly not good, it was not disastrous for Lowe's. And we can see here, they're actually beating their averages for profitability in gross margin and operating margin, beating their 5 and 10-year averages, as well as increasing their return on invested capital and their return on capital employed. So I'm certainly not happy with the earnings for Lowe's this quarter. However, I don't think it's anything to be too concerned about yet. I do want to see them turn this around in the next few quarters, I expect 2024 to be a lot better economically for the consumer than 2023, and Lowe's should certainly benefit from that. However, I do think right now is actually a pretty good time to pick up some Lowe's. We can see their 52-week high at $235.09, and they're clearly off of their highs they hit earlier in the year. So I actually did pick up a couple shares today of Lowe's when the markets opened this morning. It was a disappointing quarter for Lowe's. However, once their investments bear some fruit, we should see their returns accelerate along with their earnings. So before we go, I do want to remind you that this is not financial advice, and I do own a stake in Lowe's. With that, thank you for watching today's video. And what do you think? I love the feedback, so please comment below with your thoughts. Also, please hit that like button. And if you found this info helpful, please subscribe to our channel and join our community. Thank you, and happy investing.